The Merian UK Alpha Fund, managed by me and my colleagues on the large cap desk, is a fundamental stock picking portfolio. So we do our homework, we meet our companies regularly and often. We're trying to identify winning business models where we can trust the management team to really deliver improvements in profitability and grow the business. It's a large cap orientated fund, typically FTSE 100 and top of the mid cap space, not right down into the small cap world. We have other funds to do that. But very much the emphasis on identifying good companies, backing them for the long term. We may well research companies for a year or more before actually making an investment, because we're going to be there 3, 5, 7 years and more. We devoted a lot of time to analysing Brexit, but it is one of those almost unforecastable events. The real impact is through the currency. It's felt through sterling. Any sign of a risk of a no deal and sterling has weakened, sign that there's going to be a good deal and sterling has rallied. That has impacted the domestically focused companies relative to the big multinational earners. So clearly, as sterling has been rallying of late, suggesting that the risk of a no-deal Brexit is fading, so some of the stocks that I hold, Next, Whitbread, Lloyds Bank, the very UK-focused businesses, have indeed been rallying. It's been a bit of a headwind for some of the big multinational stocks, but to be honest, I think that any modest profit downgrades because of a stronger sterling will only be a kind of minor event for a short period of time, because the overall relief that we actually have got a deal, I think will dwarf the impact of any of those profit adjustments. Global investors have sold out significantly from UK equities. And the prospect of them beginning to come back and recognise that we do actually have some pretty good companies here in the UK, I think that'll be the much more powerful phenomenon. The data has been softer recently. Historically, we've been growing at around 0.5% a quarter, and that's really come down to about 0.2, 0.3%. But I think, as I say, that if we can just get the uncertainty lifted, then actually both business confidence, consumer confidence at the margin will pick up again. We've actually got the private sector seeing good wage growth, around 3%. The Chancellor has made it very clear that he's going to spend money now post-Brexit, so it may even be that you get a little bit of public sector wage growth as well. We've got a very strong labour market. A number of job vacancies actually continues to rise, even though we've never had as many people in full-time employment here. So tonight I'm actually quite upbeat about the UK economy once we can get through this Brexit issue. But and I think by contrast to Europe, which is clearly really struggling in GDP terms, actually the UK could positively surprise through the balance of 19 and into 2020. Financials generally have been unloved for a number of years, partly due to very low levels of interest rates and no changes in interest rates, very low level of bond yields. So that's been a real headwind for stocks like Aviva, some of the banks. Barclays trades at a very significant discount to its book value, purely because investors are sceptical that they can ever improve the returns from the investment bank to levels akin to their targets. I continue to have a bit more confidence that actually, as volatility picks up, that there will be opportunities for them to improve returns. So certainly some of the financial stocks are significantly undervalued. I'm still a very happy holder of Lloyds. Yes, they have done well, but that's from quite a low point towards the back end of last year. They've delivered good results. They've reassured people with a very significant increase in both ordinary dividend and share buybacks. It makes sense, given where the shares are trading at the moment, for the bank to be buying back shares and retiring capital. So yes, I still think that they're undervalued, that you can continue to see them pushing down the cost-income ratio, continuing to improve profitability, and support the wider UK economy. So no, I still think there's further re-rating to go. Yes, and it's true there's merit perhaps in having a greater focus on one. There's a slight preference for BP at this juncture. But the reason I like both stocks is that the oil industry has always, because it's such a capital intensive business, been a very early adopter of new technology. And it's no different this time round. So a lot of the new technologies that have been developed in the US shale oil and gas business, that's materially reducing finding costs, it's reducing the break-even levels for these oil majors, it's enabling them to find oil in seemingly mature wells. You know, all of these things are leading to a very significant pickup in productivity in these big oil companies. So it's funny when people say, well, you know, are you not investing in a lot in technology? Well, actually, it is the companies that are using new technology to improve their existing profitability that could be real winners. And I think the oil majors, both BP and Shell, fit that category.